Friends, thank you for being here today. I want you to sit with a question for just a moment, not because it is rhetorical, but because the answer to it should disturb you. What if the single most powerful signal about the future of the Canadian economy was not delivered by an economist, not printed on the front page of any newspaper, and was not broadcast during any evening news segment, but was instead buried inside a dry 14-page regulatory announcement released on December 18, 2025 by a government body most Canadians have never heard of? What if in that document, the most important financial regulator in this country quietly told every major bank, do not lend money in 2026. That is not a metaphor. That is not a conspiracy. That is a stated policy. And the silence around it, the complete absence of alarm, is, in my view, the most dangerous thing happening in Canada right now. Here is the paradox at the center of all of this, and I want you to hold it carefully. When an economy begins to slow, when growth stalls, when households are under pressure, when businesses are contracting, the standard textbook, universally accepted response from financial regulators is to loosen the capital buffers at the banks. You free up cash, you encourage lending, you inject oxygen into an economy that is running low. Every central banker, every regulator, every economist from left to right agrees on this. It is Economics 101, counter-cyclical policy. When things get bad, you open the taps. On December 18th, 2025, the Office of the Superintendent of Financial Institutions, OSFI, the body that governs the architecture of Canada's entire banking system, did the opposite. They kept the domestic stability buffer at 3.5%, the record high, the absolute ceiling. In a slowing economy, with households groaning under the weight of debt, with corporate credit showing early fractures, with the housing market balanced on a knife's edge, Canada's top banking regulator looked at all of it and said, we are not releasing a single dollar. Now, why does that number matter? Because of what it forces the banks to physically do. The DSB, the domestic stability buffer, is a percentage of what are called risk-weighted assets. Every major bank in this country holds an enormous portfolio of loans, mortgages, credit lines. That 3.5% buffer means that Canada's 6 largest banks, the Royal Bank, TD, Scotiabank, BMO, CIBC, and National, must collectively lock away approximately $60 billion in capital that cannot, under any regulatory framework, be deployed as loans. $60 billion frozen, sitting in a vault, not available for the mortgage you are trying to refinance, not available for the small business credit line that keeps 12 employees on payroll, not available for the construction loan that would have turned into 40 units of housing, $60 billion padlocked, and the unlock date reads, to be determined. This is the staggering number I want you to hold on to, because it is the foundation of everything we are going to discuss today. This is not an abstraction. This is not a theoretical policy framework. This is $60 billion of liquidity that has been surgically removed from the Canadian economy at the precise moment when that liquidity is most desperately needed. And the people who made that decision, the career regulators at OSFI, the ones who spend every working hour reading stress test models and default probability curves, they did not do this by accident. They did not do this carelessly. They did this because they know something. The question this video is going to answer is, what exactly do they know? Let me give you an analogy, because I think it makes the mechanics here viscerally clear. Imagine your neighborhood has a fire department. well-staffed, well-funded. Their trucks are full of water. The house 3 doors down is already smoking. You can smell it, your neighbors can smell it, but the fire chief refuses to deploy the trucks. He tells his crew, "Save the water. There is a bigger fire coming. We cannot afford to use our reserves on this one. We need to be ready for what is coming next." That is OSFI right now. The house is smoking, and they are saving their water. To understand why they made this decision, why a regulator would willingly strangle lending in a contracting economy, we have to go back and understand the architecture of the problem they are actually afraid of. Because this decision was not made in a vacuum. It was made in response to a specific structural fault line that has been building inside the Canadian economy for years and which is about to reach its most dangerous phase. The story begins, as these stories always do, not with today's headlines, but with a decision made years ago that set the entire machinery in motion. Cast your mind back to 2020 and 2021. The world economy has been deliberately shuttered. Central banks are in full panic. The Bank of Canada slashes interest rates to emergency lows. The overnight rate falls to 0.25%. And what do Canadians do? They do exactly what any rational person would do when money is free. They borrow it massively. They lock in 5-year fixed-rate mortgages at rates that in any historical context look almost surreal. 1.49%, 1.59%, 1.79%. People who had been waiting on the sidelines, first-time buyers, move-up buyers, investors, they flooded into the market. The fixed-rate mortgage at under 2% felt like a gift. It felt like security. It felt like the sensible, responsible thing to do. And so they signed. They signed millions of contracts, millions of 5-year fixed-rate agreements, tying their financial futures to interest rates that the Bank of Canada, through extraordinary and unprecedented policy intervention, had artificially compressed to generational lows. Those contracts are now maturing. The 5-year clock started ticking in 2021, which means it runs out in 2026. Not a few of them, a wave of them. The single largest cohort of mortgage renewals in Canadian history is arriving in 2026, and every single one of those borrowers is stepping off a rate of roughly 1.5% and stepping onto a rate of somewhere between 4.5% and 5.5%, depending on the day they renew and the mood of the bond market. Do the arithmetic on a standard Canadian mortgage. A family that borrowed $600,000 at 1.79% was paying approximately $2,450 a month. That same mortgage, renewed at 4.99%, costs them approximately $3,500 a month. That is over $1,000 more every single month. Not going toward a vacation, not going into savings, not going into the local economy, simply evaporating into interest payments for millions of families simultaneously. That is what OSFI calls payment shock. That is the phrase in their internal models, payment shock. And they know, with the precision of actuaries, that payment shocks of this magnitude do not produce defaults immediately. There is a lag. A family receiving a renewal letter in March 2026 does not miss a payment in April. They miss a payment in October after they have exhausted their savings, after they have maxed the credit cards, after they have borrowed against the car, after every buffer has been stripped away. The defaults arrive 6 months late, and OSFI knows this. They are pre-positioning. The $60 billion buffer they are holding right now is not reactive. It is prophylactic. It is the firewall they are building in December 2025 for the defaults they are forecasting for late 2026 and into 2027. This is a structural fault line, and they can see it on their models with mathematical clarity. But payment shock, devastating as it will be, is only one of the fractures OSFI is watching. The second crack runs through the corporate sector, and it is just beginning to show. Here is what the official language sounds like: elevated household indebtedness and uncertainty in housing. That is the diplomatic phrasing from the OSFI announcement, but read it as a banker reads it. Elevated household indebtedness means the average Canadian family has borrowed to the absolute limit of their income's capacity to service debt. There is no buffer, there is no slack, they are fully extended. And uncertainty in housing is the regulator's way of saying we are not sure the collateral backing all of these mortgages is worth what it was appraised at. This is the system's most crucial secret, which we will explore in detail shortly. But let me plant the seed now. A bank's balance sheet is only as strong as the assets underlying its loans. When a bank lends you $700,000 to buy a house, the house is the security. The house is what they can sell if you default. If the house's value drops, if the market corrects, if forced selling compresses prices, the bank's actual loss on that loan is no longer theoretical. It becomes real. And across millions of mortgages, even a 15% decline in collateral value begins to reshape the CET1 ratios, the core equity tier 1 ratios that determine whether a bank is genuinely solvent or merely solvent on paper. The CET1 ratio is the true measure of a bank's health, not the stock price, not the dividend, not the press release. The CET1 ratio. Canada's big six banks are currently averaging approximately 13.6%, which sounds robust, and in normal times it is. But the question is what happens to that number when you apply the stress test scenarios OSFI is actually running internally? What happens when mortgage delinquencies start climbing in Q3 2026? What happens when corporate credit lines, already showing strain, begin to default in clusters? The buffer they are holding today is the margin of safety between well-capitalized and something far more precarious. And this is where we arrive at what I call the big secret of the entire system. The banks are not just holding this capital because OSFI told them to. They are holding it because it serves a second, deeply strategic purpose that almost no one in the financial media is talking about. Here is the insider angle that changes how you see this entire picture. When OSFI forces a bank to maintain a 3.5% domestic stability buffer, it does not just constrain the bank's lending. It also hands the bank a shield, a regulatory excuse, a pre-built defense against one of the most uncomfortable conversations that bank executives have with their shareholders every quarter. Why are we not returning more capital? Why are we not doing buybacks? Why are we not increasing the dividend? In normal times, that pressure is enormous. Institutional investors, the pension funds, the asset managers, the index funds, they expect Canadian banks to be capital return machines. It is the entire investment thesis. Buy the bank, collect the dividend, watch the buybacks shrink the share count. That is the trade. And when management starts saying we need to conserve capital, the shareholders get nervous. They start asking uncomfortable questions. They start wondering what management knows that they do not. But when the answer is the regulator is making us do it, when OSFI is publicly on record demanding that this capital be locked away, the banks can shrug and point to the rule book. It is not us, they can say. It is OSFI. Our hands are tied, and the shareholders nod and accept it because what else can they do? This is a defensive crouch, a deliberate, coordinated, mutually beneficial arrangement. OSFI gets its stability buffer. The banks get cover to hoard cash without panicking their investors. And the Canadian public gets told that everything is fine. The banks are well capitalized. The system is sound. There is nothing to worry about. They are telling you the flight is smooth while quietly checking the oxygen masks. This is not a conspiracy. It is a stated policy. But the gap between what is being communicated publicly and what is actually being prepared for behind closed doors, that gap is where the danger lives. And the danger is already spreading because the effect of a $60 billion capital freeze does not stay neatly contained inside a regulatory document. It leaks into the real economy through a mechanism that is quiet, informal, and almost invisible until it is too late. Let me explain exactly how it works. When a bank is required to hold more capital against its risk-weighted assets, every new loan it makes becomes more expensive from a regulatory standpoint. The more loans it writes, the more capital it must tie up. So the rational response, the response that every credit committee at every major Canadian bank is currently implementing, is to become dramatically more selective about which loans get approved. This is what I call the silent rejection, and it is already happening. You will not receive a letter telling you your mortgage refinance was denied because the bank is conserving regulatory capital. You will not be told that your small business credit line was cut because OSFI has forced the bank into a defensive posture. Instead, you will be told that the appraisal came in lower than expected. You will be told that your debt service coverage ratio does not quite meet current guidelines. You will be told to come back in 3 months with more documentation. You will be told in the polite bureaucratic language of institutional finance that the answer is no, without ever being told the real reason why. The real reason is this: the bank is rationing capital, and when capital is rationed, it does not flow to the people who need it most. It flows to the people who need it least. The large corporations with investment-grade credit ratings, the property developers with established relationships and deep balance sheets, the high net worth individuals with multiple assets as collateral. These are the borrowers who still get approved. Everyone else, the small business owner trying to bridge a cash flow gap, the family trying to refinance at renewal, the first-time buyer trying to get into the market, they are the ones who find the doors quietly closing. And here is the mechanism that makes this truly dangerous. The regulator acts to prevent a recession, and in doing so, creates one. Think through the chain carefully. OSFI is afraid of mass defaults, so they force the banks to hold capital and restrict lending. The restricted lending means small businesses cannot access the credit lines they need to survive a slow quarter. Businesses that could have been saved with a $200,000 credit facility instead start laying off staff. Those staff members, suddenly unemployed, stop spending. The businesses that relied on their spending see their revenues fall. More layoffs follow. The mortgage renewals that were going to be stressful but manageable become catastrophic because now the borrower has lost their income. The defaults OSFI was afraid of arrive earlier and in larger numbers than the models predicted, precisely because the lending restriction that was supposed to prevent them accelerated the conditions that caused them. This is what economists call a pro-cyclical feedback loop. And it is, in my view, the most pernicious trap in the entire architecture of modern financial regulation. The tools designed to prevent a collapse can, when applied at the wrong moment and at the wrong intensity, become the instruments of the very collapse they were built to prevent. The canary in this particular coal mine is already singing, if you know how to hear it. Look at the consumer delinquency data that OSFI itself is citing as justification for the buffer. Credit card delinquencies in Canada have been climbing steadily since mid-2024. Auto loan defaults, particularly in the subprime segment, have been ticking upward in a pattern that anyone who watched the American housing crisis of 2008 would find uncomfortably familiar. These are not the big defaults. These are not the mortgage defaults. These are the small ones. The credit card minimum that gets missed, the car payment that goes 30 days late. These are the early tremors before the main event. And they are happening right now, while the economy is still technically growing, while unemployment is still technically contained, while the banks are still technically posting profits. Imagine what those numbers look like when the payment shockwave from the 2021 mortgage cohort hits in full force. There is a specific category of corporate borrower that is already showing the stress fractures, and I want to name it precisely because I think it illustrates the hidden rot inside the system better than any chart or statistic can. It is the mid-market commercial real estate developer, the ones who borrowed heavily during 2020 and 2021 to acquire land and begin projects, office conversions, mixed-use developments, multifamily residential, on the assumption that rates would stay low and construction costs would normalize. Those two assumptions were both wrong. Rates went up, construction costs stayed elevated. And now these developers are sitting on projects that are partially complete, drawing on credit facilities that the banks are beginning to nervously revisit, staring at loan-to-value ratios that no longer make sense at current market valuations. These are not headline failures yet. They are not Lehman Brothers moments, but they are the invisible stress fractures running through the foundation of the edifice, and the OSFI stress test models are full of them. When the capital buffer gets deployed, and I want you to hear this carefully, it will not be deployed for the homeowner on your street who misses a payment. It will be deployed to absorb the losses from these mid-market commercial collapses that nobody is currently reporting on because they have not yet technically failed and the liquidity tide is going out. We are about to find out who has been swimming naked. Now, I want to address something directly because I know what a portion of you are thinking right now. You are thinking, if things are really this precarious, why are the bank stocks still holding up? Why is the TSX not in free fall? Why are the dividend yields still intact? These are fair questions, and the answer to them is simultaneously reassuring in the short term and deeply troubling in the medium term. The answer is timing. Markets are forward-looking, but only to a horizon they can see clearly. The payment shock from the 2021 mortgage cohort is a 2026 event. The corporate credit deterioration is a slow bleed, not a sudden hemorrhage, at least not yet. The consumer delinquency data is alarming to someone reading the trend, but it is still within ranges that can be dismissed as normalization by an analyst who needs to maintain a price target. The system appears stable because the catastrophic outcomes are still 6 to 12 months away. And in financial markets, 6 to 12 months is a very long time to be early. But here is what I need you to understand about the relationship between timing and preparation. The window in which you can act, the window in which adjustments are still possible, in which there is still flexibility, in which the choices you make actually change your outcome. That window closes well before the crisis becomes visible, by the time the mortgage default wave is front page news, by the time the credit crunch is a term being used on the evening broadcasts, by the time the banks are openly acknowledging what their regulatory filings are already quietly showing. By that time, the options available to ordinary Canadians will have already narrowed dramatically. The people who respond to this information today are operating with maximum optionality. The people who wait for confirmation will find that the confirmatory evidence arrives precisely when acting on it is most difficult and most expensive. This is what OSFI understands. They are not waiting for the crisis to materialize before responding. They acted in December 2025, months before the peak renewal wave, months before the delinquency data gets ugly, because in systemic risk management, you must always act earlier than feels necessary. The problem is that OSFI can act early and quietly through a regulatory mechanism that generates minimal public attention. You and I do not have that luxury. We only get to act when we choose to pay attention. And now I want to talk about what this convergence of forces actually means, not for the banks, not for the regulators, not for the economists, but for you, for your household, for the choices you are facing in the next 12 months. Because we are not dealing with a single threat here, we are dealing with a trifecta, three distinct forces converging simultaneously on the same pressure point, and the interaction between them is what makes the coming period genuinely dangerous rather than merely uncomfortable. Let me lay the three forces out with precision, because I think when you see them together, when you see the convergence, the picture becomes impossible to dismiss. Force 1, the record high capital buffer, the $60 billion that has been surgically extracted from the lending capacity of Canada's 6 largest banks and locked behind a regulatory wall. This is a supply-side constraint. The supply of money, of credit, of liquidity has been deliberately, formally, and for the foreseeable future restricted at the exact moment in the economic cycle when it is most needed. Businesses that need capital to grow cannot get it. Households that need refinancing cannot access it. The architects of the system have pulled the oxygen out of the room and told us to breathe normally. Force 2, the record high debt renewals, the demand side. Millions of Canadian households, families who made a perfectly rational financial decision in 2021 when they locked in at 1.5%, are walking into renewal conversations in 2026, facing payment increases of 30 to 50%. This is not a small cohort. This is not a marginal population. This is the mainstream of Canadian home ownership. These are nurses and teachers and engineers and small business owners who stretched to get into the market at what they believed were sustainable rates, because the Bank of Canada told them rates would stay low for the foreseeable future. They were told the runway was clear. Now the runway has a wall at the end of it, and they are approaching it at full speed with no room to slow down in a credit environment where the banks have been instructed to be as selective as possible. Force 3, the stagnant economy, the income environment in which all of this is unfolding. Real wage growth in Canada has been negative or flat for the better part of 2 years. The sectors that were supposed to absorb laid-off workers, technology, finance, professional services, have been contracting, not expanding. The manufacturing base that sustained middle-class incomes in the previous generation has been systematically hollowed out. The gig economy that replaced it does not provide the stable, predictable monthly income that a bank's debt service calculator requires. So we have households facing dramatically higher debt payments, applying to banks that have been told to restrict lending in an economy that is not generating the income growth that would make any of it serviceable. These are not three separate problems. They are three faces of the same structural collapse, and they are all arriving at the same moment in the same country, affecting the same households. This is a singular inevitability, not a possibility, not a risk scenario in a stress test document, a mathematical endgame. When you restrict the supply of credit, simultaneously spike the demand for credit, and hollow out the income base that services all of it, you do not get a soft landing, you get a credit crunch. And Q1 and Q2 of 2026 will, in my view, be remembered as the moment that crunch became undeniable. But before we talk about what to do, before we discuss the concrete, practical choices that this moment demands, I need to address something more important than money, because the most dangerous threat you are facing right now is not the $60 billion capital freeze. It is not the payment shockwave. It is not the pro-cyclical feedback loop. It is something far more personal and far more insidious. It is your own psychology. Human beings are hardwired to believe that tomorrow will look like yesterday. This is not a character flaw. It is not ignorance or laziness. It is a deeply embedded cognitive architecture that served our species extremely well across most of human history. When the environment is stable, the assumption that stability will continue is almost always correct. The sun rose yesterday. It will rise tomorrow. The harvest came in September last year. It will come in September this year. Extrapolation from recent experience is, in the vast majority of circumstances, the most rational strategy available. But this bias, what behavioral economists call normalcy bias, becomes catastrophic at precisely the moments when the environment is not stable, when the underlying structure is changing, when what you are about to experience is genuinely different from what you have experienced before. And the tragedy is that the stronger the recent track record of stability, the more powerful the bias becomes. The longer nothing bad has happened, the more certain you feel that nothing bad will happen. The Canadian banking system has not experienced a systemic crisis in living memory. It sailed through 2008 relatively unscathed. It absorbed the COVID shock with government support. Every crisis that was supposed to break it failed to do so. And that extraordinary record of resilience has created, I believe, a national level normalcy bias that is now one of the most dangerous forces in the country. Because the question is not whether the Canadian banking system will survive what is coming. It almost certainly will, in some form, with some combination of regulatory intervention and government support. The question, the one that actually matters for you sitting where you are right now, is what happens to you while it survives. What happens to your mortgage payment when you cannot get refinanced at a competitive rate because the banks are conserving capital? What happens to your savings when the purchasing power of the cash in your account is being silently consumed by an inflation rate that the official statistics persistently understate? What happens to the paper value of your investment portfolio when the liquidity tide goes out? This brings me to the second psychological trap I want to name, because I think it is the one that is quietly impoverishing the most people in the most insidious way. It is what economists call the money illusion. The money illusion is this: You look at your bank account, and the number is larger than it was 5 years ago. You look at your investment portfolio, and the number is larger than it was 5 years ago. You look at the assessed value of your home, and the number is dramatically larger than it was 5 years ago. You feel wealthier. The numbers are going up. This feels like progress, but wealth is not a number. Wealth is purchasing power. Wealth is the actual quantity of real goods and services that your accumulated assets can command. And when you measure your net worth not in nominal dollars, but in what those dollars can actually buy, a tank of gas, a basket of groceries, a contractor's hourly rate, a square foot of livable space, the picture looks very different. You may have become a millionaire on paper while becoming meaningfully poorer at the grocery store. The number went up. The reality went down. That gap between the nominal figure and the real purchasing power is the money illusion at work. And it matters right now in this specific moment because the choices you make about how to hold your assets determine whether you are protected against that illusion or consumed by it. When the credit crunch tightens, when liquidity drains from the system, when asset prices that were inflated by cheap debt begin to reprice to reflect a world of expensive credit, the assets that hold their value are not the ones denominated in the currency that is being inflated. They are the ones that exist outside that system entirely, which brings us finally to the only question that actually matters. Not what is happening, not why it is happening, not even when it is happening, but what you do about it. Here is the binary choice, stated as plainly as I know how to state it. Do you own assets or do you own claims on assets? This distinction sounds academic until you understand what it means in a credit crunch. A stock is not an asset. A stock is a claim on the future earnings of a company, settled in a currency that a central bank can print, held through a brokerage that can restrict access during a liquidity crisis, valued by a market that prices it based on the availability of credit. When credit tightens, equities fall. Not because the underlying businesses have necessarily deteriorated, but because the liquidity that was supporting their valuations has evaporated. The paper claim becomes worth less paper. An exchange-traded fund is not an asset. It is a claim on a basket of claims, mediated by a financial structure that has its own liquidity risk in a stressed market. During the March 2020 liquidity crisis, ETFs that were supposed to track bond prices were trading at discounts to their net asset values because the mechanism that keeps the price aligned broke down under stress. The claim on the asset stopped behaving like the asset. Cash is not an asset in an inflationary environment. It is a claim on a government's promise to maintain purchasing power. A promise that has been broken systematically and measurably for the entirety of the modern monetary era. Real assets, physical gold, physical silver, productive land, direct ownership of real property without excessive leverage. These are not claims. These are the things themselves. You cannot print more gold. You cannot create land through quantitative easing. You cannot inflate away the physical existence of silver in your hand. In every historical episode of monetary disorder, of credit contraction, of currency debasement, of systemic banking stress, hard assets have been the mechanism by which wealth survived the reset. Not because they generate spectacular returns in a bull market, but because they do not disappear when the scaffolding collapses. I am not telling you to liquidate everything and bury gold in your backyard. I am telling you something more precise and more urgent than that. I am telling you to look at your balance sheet, the real one, not the nominal one, and ask yourself honestly, what percentage of my wealth exists in the form of actual physical real assets that no counterparty can default on? And what percentage exists as a claim, a promise, a number in a database, a legal right to receive something from an entity that is itself operating inside a system that is currently under significant stress? If the answer to that first question is zero or close to zero, then you are entirely inside the system that is under pressure. You have no position outside the line of fire. And stepping outside that line of fire, even partially, even incrementally, is not an investment decision. It is a survival decision. It is the same decision a prudent household makes when it keeps 3 months of cash for emergencies, not because it expects a crisis, but because the cost of being prepared is trivially small compared to the cost of being unprepared. The banks know this. That is the message of December 18th, 2025, if you are willing to hear it. OSFI did not lock $60 billion away because they are confident everything is fine. Regulators who are confident everything is fine lower the buffer. They did not lower it. They held it at the record high in a slowing economy against every textbook prescription because their models are telling them something that the official narrative is not. They are hoarding cash. They are preparing a war chest. They are bracing for impact while telling you the flight is smooth. You are not a regulator. You do not have the power to force $60 billion of capital to sit in reserve, but you do have the power to apply the same logic to your own household. You do not have to wait for the official announcement that the turbulence was real. You do not have to wait until the mortgage default headlines are unavoidable. You do not have to wait until the credit crunch is named and confirmed and analyzed on every financial broadcast. You can look at what the most sophisticated risk managers in the country are doing right now, quietly, without fanfare. And you can make your own decision about whether their behavior tells you something that their words do not. Watch what they do, not what they say. The convergence is already underway. The fault lines are not forming, they are already formed. The $60 billion freeze is not a precaution against a hypothetical future. It is a response to a structural reality that exists today in the balance sheets of millions of Canadian households, in the renewal calendars of every major mortgage lender, in the delinquency curves that are already bending upward before the main wave has even arrived. The window for preparation does not stay open indefinitely. In every financial disruption, without exception, across every historical episode I have studied, there is a period of clarity before the chaos. A moment when the information is available, when the signals are legible, when the choices are still genuinely choices rather than desperate reactions. That window is open right now. The OSFI announcement of December 18th is a data point. The payment shock arithmetic is a data point. The pro-cyclical feedback loop is a data point. The consumer delinquency trends are a data point. None of them individually is the alarm bell. Together, they are the alarm bell, and the bell is ringing. History favors the prepared, and the window for preparation is closing. Friends, thank you for staying with me today. This is not easy material, and the fact that you are here, that you are willing to sit with uncomfortable information rather than retreat into the comfort of the official narrative, that is itself a form of preparation, Because the first step in protecting yourself from a crisis is acknowledging that the crisis is real. Everything else follows from that. Stay informed, watch what they do, and take care of yourselves and the people around you.